Every day, trillions of dollars vanish and reappear. Numbers on a screen determine the fate of empires, the livelihood of millions, and the security of your future. We call it the stock market. We're told it's the engine of capitalism, a rational machine for allocating capital, a barometer of human progress. We see the graphs, hear the jargon, feel the anxiety or euphoria. But what if you've been sold a story? What if this vast digital nervous system of global finance wasn't born in a boardroom of sober calculation, but in the taverns and docks of 17th century Amsterdam, fueled by Tulip Mania, maritime disaster, and outright fraud? What if its very DNA is not pure efficiency, but a volatile cocktail of human greed, fear, and narrative? This is not a tutorial on how to pick stocks. This is an origin story. The story of how a simple, elegant idea-owning, a piece of a venture mutated into the most powerful and unpredictable force on the planet. We will trace its evolution from handwritten share certificates to AI-driven microsecond trades. We'll witness the catastrophic breaks in its logic that repeat with eerie similarity every generation. And we'll uncover the single counterintuitive truth about what the market actually values. This is the real history of the stock market, a 400-year experiment in collective psychology. And you are an unwitting participant. Forget Wall Street. The story begins with pepper and nutmeg and silks from the East. In the late 1500s, a voyage from Europe to the Spice Islands of Asia was the riskiest, most capital-intensive endeavor imaginable. It required a fortune to outfit a ship. Storms, pirates, disease, and rival nations meant the odds of total loss were high. But the payoff, if you made it, was astronomical. For a single merchant, the risk was too great. The solution? The joint stock company. A group of investors would pool their capital, sharing both the monumental risk and the potential reward. The most famous of these was the Dutch Verenigd Oostenrijk Company, the Dutch East India Company, founded in 1602. Here was the revolutionary idea. Instead of dissolving after one voyage, the company was permanent. Investors who put up money received a physical certificate, share of the company's profits, and because these voyages took years, an investor might need his money back before the ship returned. So, a secondary market emerged. You could sell your share of future profits to someone else. A trade happened in a coffee house or on a bridge. The price wasn't set by a central authority. It was a negotiation based on rumor, hope, and the latest news from the docks. This was the genesis. The share was born not as a speculative token, but as a pragmatic tool to finance impossible journeys. The cause was immense, tangible risk. The effect was the invention of tradable equity. The Dutch East India Company didn't just trade goods, it wielded private armies, established colonies, and minted its own coin. It was, in effect, a state-sponsored for-profit empire, and its shares began to trade actively. By 1609, Amsterdam had a dedicated building for this trade, the Amsterdam Stock Exchange. The world's first official stock market. The stage was set, the tool existed. Now, human nature was about to take the wheel. The market had barely learned to walk before it started to sprint off a cliff. The tool for sharing maritime risk was now applied to something far less tangible: future desire. In the 1630s, a virus of speculation infected the Netherlands. Tulip Mania, new exotic varieties of tulip bulbs became status symbols. Bulbs were traded via futures contracts promises to buy at a later date. At its peak, a single bulb of the Semper Augustus tulip could trade for the price of a grand Amsterdam canal house. This was the first critical twist: the decoupling of price from intrinsic value. The value was no longer in the bulb's utility or even the company's profit, but purely in the belief that someone else would pay more. It was a pure greater fool market. The cause was scarcity and social contagion. The effect was a price graph that shot vertically, and in 1637, the music stopped. Confidence faltered, buyers vanished, and the market collapsed overnight, ruining many. The first bubble had popped. The lesson wasn't learned. Less than a century later, in London, the South Sea bubble of 1720 repeated the script, but with the added ingredient of government complicity. The South Sea Company, granted a monopoly on trade with South America, offered to take over the British national debt in exchange for more shares. It was a shady debt-for-equity swap that captured the public imagination. Its stock price soared nearly tenfold in months. A wave of other bubble companies formed, promoting absurd schemes. Even Sir Isaac Newton, the genius who formulated the laws of motion, was swept up. He invested early, sold for a huge profit, then watched in agony as the price kept soaring. He famously jumped back in near the peak, only to lose a fortune. He later lamented, "I can calculate the motion of heavenly bodies, but not the madness of people." The collapse was inevitable and devastating. The fallout, a deep public distrust of joint stock companies and stock markets. For decades, the very idea of public markets was seen as a dangerous casino. The cause was greed amplified by financial engineering and political corruption. The effect was a regulatory freeze and a stunted financial system. The market's fix was to retreat, to become a quiet club for the wealthy few. The baton passed to a new world. In 1792, 24 brokers in New York signed the Buttonwood Agreement under a tree on Wall Street, agreeing to trade with each other and set commissions. The New York Stock and Exchange Board was born. For its first decades, it was a sleepy affair. The catalyst for its explosive growth was not a fancy financial product, but steam and steel, the railroads. Building a transcontinental railroad required more capital than even the richest tycoons could muster. The joint stock company was reborn as the modern corporation. Thousands of miles of track were financed by selling shares to the public. This created something new, a share in infrastructure, in a tangible, nation-building asset. The cause was the Industrial Revolution's insatiable appetite for capital. The effect was a massive expansion of the shareholder class and the true birth of the modern stock market. But with it came new demons, ruthless operators who manipulated railroad stock through printed lies, phantom shares, and brutal corners, creating and destroying fortunes on a whim. The technology accelerated the mania. The invention of the stock ticker in 1867 was as revolutionary as the Internet. For the first time, prices could be transmitted almost instantly across the country. Speculation was no longer confined to Wall Street. It could happen in any town with a telegraph wire. The market was democratizing, for better and worse. This culminated in the Panic of 1901, a fight for control of the Northern Pacific Railway between titans. Their bidding war drove the stock price to insane heights, then collapsed, sucking the rest of the market down with it. The pattern was clear. Even shares in real productive assets could become pawns in games of pure power, disconnected from the value of the steel and crosties beneath them. The 1920s brought the next great wave of democratization. The post-WWI economy boomed. New technologies like radio and automobiles captured the imagination, and a new financial innovation made speculation accessible to the masses, buying on margin. You could buy $1,000 of stock with only $100 of your own money, borrowing the rest from your broker. The cause was technological optimism and easy credit. The effect was a speculative frenzy where everyone, from tycoons to chauffeurs, was playing the market. The underlying value of companies mattered less than the upward momentum. The narrative was that stocks had reached a permanently high plateau. The breaking point was Thursday, October 24, 1929, Black Thursday. The mechanism was the margin call. As prices began to fall, brokers demanded their loans back. To pay, investors had to sell their stocks, which drove prices down further, triggering more margin calls. It was a violent, self-reinforcing feedback loop. The market wasn't just falling, it was liquidating itself. The great crash that followed wasn't just a market event, it was a systemic collapse of trust. Banks that had speculated in the market failed. Savings vanished. Global trade ceased. The fallout was the Great Depression. The failed fix was the initial, tepid response of leaders who still believed in the market's self-correcting nature. It took the seismic reforms of the New Deal, the creation of the SEC, the Glass-Steagall Act, and the FDIC to restore a semblance of order. The lesson was that an unregulated market could devour itself and the real economy with it. The post-war era saw the rise of the institutional investor, the pension fund, and mutual fund, making the market more professional, but also more detached from individual company ownership. Then came the true revolution, the digitization of everything. The cause was the computer. The effect was a complete transformation of the market's soul. First, it democratized access. Axis Aganin line brokerages in the 1990s let anyone trade from their desktop, leading to the dot-com bubble. The narrative was the new economy, where profits were obsolete. The pattern was the same: a transformative technology, easy capital, and a story that justified any valuation. The crash in 2000 wiped out trillions in market value. Second, and more profoundly, it changed the nature of the participant. Algorithmic and high-frequency trading now dominate. Trades are executed in microseconds by machines following mathematical models, not human analysis of a company's worth. The market is a network of servers competing on the physical distance to an exchange's data center. This has created flash crashes like the trillion-dollar event of May 2010, where the market lost and regained 10% of its value in 36 minutes for no fundamental reason. The market is no longer just a place to own a piece of a company. It is a high-speed information processing system, a battlefield of algorithms, and a global casino all at once. The individual shareholder is now a plankton in a sea of institutional and algorithmic whales. Look at the last decade and you see the same ancient patterns wearing new digital masks. The GameStop saga of 2021. A narrative-driven, social media-coordinated mob of retail investors used new commission-free trading apps to execute a short squeeze against powerful hedge funds. It wasn't about GameStop's future profits. It was about a story of rebellion. The cause was social narrative and accessible tools. The effect was a violent, irrational price spike that broke several funds and revealed the market's continued vulnerability to coordinated sentiment. The cryptocurrency roller coaster. This is the purest modern echo of Tulip Mania and the South Sea bubble. Assets with no cash flow, no underlying productivity, valued purely on belief, narrative, and the greater fool theory. The bubbles and busts are fractal, happening on shorter and shorter time frames. The rise of the meme stock and the AI narrative. Companies are now valued not on current earnings, but on their connection to a compelling future story. This is not new. It's the Tulip variant, or railroad narrative, for the 21st century. The market has always been, and will always be, a market for stories. The shocking data point. A recent study suggested that over 90% of daily trading volume on U.S. exchanges is now driven by algorithms, ETFs, and quantitative funds, not human stock picking. We are not in the market our grandparents knew. We are in a vast, automated system that reacts to signals at the speed of light. So, after 4 centuries, from the Amsterdam exchange to the AI quant fund, what enduring truths can we extract from this turbulent history? 1. The market is a mirror, not a machine. It does not coldly calculate value. It reflects the aggregated greed, fear, hope, and narrative bias of its participants at any given moment. Its primary output is not capital allocation, but price volatility, which is simply the measure of our collective uncertainty and emotion. The efficient market hypothesis is a useful model, but history shows the market is far more often gripped by profound inefficiency. 2. Technology changes the speed, not the story. The telegraph, the ticker, the online broker, the algorithm each compressed the time frame of the market's emotional cycles. Tulip Mania played out over years, the dot-com bubble over a few. Cryptomanias can cycle in months. The human psychological script remains unchanged. The fuse just burns faster. 3. Ownership is an illusion, but influence is real. For the vast majority of modern participants, buying a share is not about owning a piece of a company's future in the way a Dutch merchant owned a piece of a spice voyage. It is a fleeting bet on price direction. The real power of ownership is concentrated in the hands of a few massive institutional funds. The individual is along for the ride, subject to the tides created by whales and machines. We stand at another precipice. With the rise of passive investing through index funds, we have created a new kind of systemic risk, a market where vast swaths of capital move in unison, not based on company performance, but on mechanical inflows and outflows. We have algorithms trading based on the sentiment they scrape from social media, creating a dizzying feedback loop between perception and reality. The next great crash may not be caused by margin calls on individuals, but by a flaw in a ubiquitous algorithm or a synchronized rush for the exits by passive funds. The market is a phenomenal tool for growth, but it is a savage god. It demands sacrifice, it runs on stories that are often lies. It rewards patience as often as it punishes it with randomness. Your defense is not trying to outsmart it in the short term. That is the game of the algorithms and the insiders. Your power lies in understanding its nature. See the market for what it is, a centuries-old theater of human psychology powered by increasingly powerful technology. Invest not in stories, but in time and the general, messy upward trend of human productivity that has, despite every panic and crash, persisted over those centuries. Use low-cost, diversified index funds not because they're glamorous, but because they are a way to harness that long-term trend while admitting you cannot predict the next story, the next mania, or the next flash crash. Most importantly, inoculate yourself against the narrative of the day. When you hear a new this time, it's different story. Remember the Tulip, the South Sea, the railroad, the radio, and the .com. The details change. The human heart does not. The history of the stock market is the history of a sour ambition, our ingenuity, and our breathtaking capacity for self-delusion. It is the greatest story ever sold, and it is still being written every microsecond. In the silent hum of a server rack and the quiet hope in an investor's heart,